Get the full global macro and markets picture with Capital Economics' all-access packages. CE Essential gives you full access to all of our award-winning written analysis, all of our online briefings, and a host of critical data tools. And for deeper engagement with our economist team, our proprietary data, and seamless integration of that data into your workflow, CE Advance is our most complete solution. Go to capitaleconomics.com today to learn more about CE Essential and CE Advance.
It's Friday, 26th of September, and this is your Capital Economics Weekly Briefing. Coming up, the US swoops in to try to save Javier Milei. What's behind this week's extraordinary intervention in Argentine markets? But first, it's Friday. That can only mean it's Neil Shearing, Group Chief Economist, to wade through another week in global macro. Hi, Neil.
Hi, David. How are you doing?
Good. I'm glad to see that Tariff Man is back. We wake up in London to news that Donald Trump wants, a deep breath, 100% tariffs on branded pharmaceuticals, 25% tariffs on heavy trucks, 50% on kitchen cabinets and the like, 30% on upholstered furniture. And then this Wall Street Journal story says the administration pressing ahead with this sort of one-for-one semiconductor plan where imported chips get hit with 100% tariffs if they're in excess of the amount produced domestically. Put this all together, I mean, the narrative has been for the past few weeks, hasn't it, that tariffs haven't had the inflationary impact that had been expected. Basically, markets seem to have stopped caring about this whole tariff threat. Does this narrative still hold?
On a personal level, I'm a bit disappointed that he didn't go for tariffs on kitchen sinks. We had kitchen cabinets instead. Had a headline just waiting to go. But I mean, you said take a deep breath because Tariff Man's back. And I think it's worth taking a bit of a breath here because the headline numbers look large, but perhaps the reaction in markets so far today tells you the likely impact of these tariffs, which we put in our rapid response overnight, we think is going to be relatively limited. The reason being that although the 100% tariff on pharma kind of grabs the headlines, there's some exemptions there that will ultimately limit the economic impact. One is that this only applies to branded products. It does not apply to generic products. More importantly, though, there appears to be a carve-out for firms that have production in the US, production facilities in the US, or are investing in production facilities in the US. Now, it remains to be seen exactly the details in all of this, but if that's the case, then the vast majority of pharmaceutical imports should be exempt. So I think that helps to explain why there's been a limited impact in markets so far today. Of course, kitchen cabinets and so on, headline puns aside, don't necessarily mean a great deal. Heavy trucks potentially more substantial and significant, but a large chunk of those come from Mexico. So again, key detail to look for will be whether there's any exemption for USMCA compliant products within those sectors, product-specific tariffs. So far, for most product-specific tariffs, there have not been USMCA exemptions apart from for auto parts. So let's see when it comes to the detail on heavy trucks. So big headlines, economic impact likely to be a bit more limited, I think.
As you say, yeah, I mean, certainly Swiss pharma stocks, for example, up a bit as we're speaking. Obviously not much reaction there. But what's striking is we had the big market hit back in the second quarter was very much about the reciprocal tariff plan, the Liberation Day tariffs hitting entire economies with these blanket tariffs. These Truth Social posts overnight, much more about product categories hitting certain goods with tariffs. Does that suggest a shift in strategies? Is this like the next phase of the Trump administration's trade agenda?
I think possibly, yes. I think it does seem to be the case, doesn't it, that the tariff landscape as it relates to reciprocal tariffs, that's to say country-specific tariffs, appears to now be pretty clear. The most US allies are getting hit with tariffs of somewhere between 10 and 15%. China and US adversaries are facing higher tariffs. And of course, we then have the tariffs on India and Brazil, which appear to be imposed for largely political reasons. And it remains to be seen how those unfold. The question then was always going to be, well, are those going to be augmented? Are those country-specific tariffs going to be augmented by product-specific ones? And the two key areas are pharma and chips. We've had the pharmaceutical announcements now. The substance is not quite as significant or as the dramatic headlines might suggest. There's the next shoe to drop will be tariffs on semiconductors. Those could potentially be more significant. But again, if there's carve-outs for firms producing in the US, and really it's only TSMC that matters here, if that's the case, then the impact, the economic impact could be more limited too. Of course, the problem with chips and semiconductors is if you impose substantial tariffs on those, then because they're embedded in so many different supply chains, cross supply chains, that has the potential to wreak havoc across trade and supply chains in a way that pharmaceutical products probably don't. So chips potentially, depending on how they're levied, could be a much bigger deal.
I said at the top that goods inflation, we haven't really seen these tariffs feeding through into that. That certainly in the US, services inflation appears to have been more problematic in recent readings. Are we going to start seeing this feeding through? Is there a certain amount of complacency in markets about the impact of all of these levies?
I think to some extent, yes. But I mean, we've always argued, haven't we, that the impact on both inflation and therefore real incomes and GDP growth in the US will be a bit more muted than some of the doom mongers have suggested. So I don't think that at the moment we've not seen the full effects of tariffs, but I don't think that means that the sky's about to fall in either. And this big kind of collapse in activity precipitated by a surge in goods inflation is just around the corner. If you look at our forecasts for US inflation, and we're in the process of just releasing new forecasts over the coming week in our quarterly outlook, we're anticipating a pickup in core goods inflation over the coming months and quarters, and a bit of a slowdown in services inflation. Those two things broadly offset, keeping headline CPI inflation and PCE inflation just about 3%. So the full effects of tariffs as it relates to inflation have not yet been felt. But that doesn't mean to say that there's going to be a big spike in inflation around the corner either.
Okay, and what about the motivations here? Because you've spoken before about the incoherence of this trade policy, where on the one hand, they welcome the revenues from higher tariffs. On the other hand, the motivation, certainly in Trump's rhetoric, is that this is all about getting jobs back to the US. The jobs and factories will come, quote unquote, roaring back into the American economy. The last jobs report we saw suggested that isn't really happening. What is the likelihood that this whole thing does strike?
I mean, it's not happening, no. If you look at what's happening to manufacturing employment specifically, which is obviously where the focus is, that is continuing to grind lower and lower and lower. So there is not much evidence, indeed any evidence, that these tariffs are having an effect on manufacturing employment and are bringing jobs back to the US. Now, I think it's possible, if you're in the administration trying to defend this policy, you can point to some areas where it may be helping, tariffs may be helping either prompt investment in the US or causing foreign firms to ramp up production in the US. So, for example, Marcel Tiliant, the head of Asia Pacific research, has put out a note over the past week noting that Japanese auto producers have ramped up production in the US. But I think these are stories at the margin. These are effects at the margin. If you look at a macro level, manufacturing employment is continuing to trend lower. So not much impact that there's a positive macro effect from tariffs. There is a fiscal impact, though. We can see this in the data. We can see the fiscal impact coming through. And of course, that's helping to keep the US budget deficit in check at around 6.5% of GDP, something like that. So still large, but without the impact of tariff revenues, it would be larger still. And perhaps that's the key issue for markets to focus on over the coming months and quarters.
I wanted to come back. Marcel's report is really interesting. One of the points he makes is that, yes, we're seeing this increase in Japanese investment in the US economy, maybe not so much about tariffs, more about the health of the economy, the strength of the US economy. We had data yesterday, economy growing annualized 3.8% in the second quarter, which kind of gets me onto this question about policy, because Stephen Miran, new Trump appointee to the FOMC, says in a speech earlier this week that he thinks the White House policy, the Trump administration policies mean that the neutral interest rate is near zero. So the Fed funds rate is basically 2 percentage points too high. And my question is, how do we square that circle where you have an economy, admittedly, second quarter data, we're looking in the rearview mirror, but it does suggest there is a lot of strength in that economy. Yet here you have a Trump appointee to the Federal Reserve saying, actually, we need to slash rates by half from where they are now.
Well, I've read the Miran speech now 3 times, and I can't make head nor tail of it if I'm being honest. I think credit to him for trying to put an intellectual framework around that now infamous dot plot. We had the dot plots, didn't we? The last FOMC meeting is pretty clear where he stood, kind of off the charts at the bottom of that dot plot, suggesting that the rates needs to fall substantially. And now this is an attempt to put a kind of intellectual framework around the idea that the neutral rate in the US, the policy neutral rate might be a lot lower. I think the problem is that it's one of those arguments that if you start to pull on a thread, the whole thing starts to unravel. Now, there are basically 2 related reasons why you might think that the effective neutral rate in the US, neutral interest rate in the US, might be lower. One is that desired savings have suddenly increased and desired investment has gone down. That would have the effect of lowering so-called R star, the neutral rate. The other might be that potential GDP growth is lower too. So return on capital is lower. That would justify a lower R star too. Now, neither of those things are developments that, as far as I'm aware, the administration wants to see. They don't want to see desired investment down relative to savings because that would imply a weak economic outlook. They certainly don't want to see weaker potential GDP growth, implying a weaker neutral interest rates. And even if you were to say the effect of the tariffs on the US economy is to essentially bring in loads of revenue, that closes the US federal budget deficit, and that releases savings into the rest of the economy, which would reduce R star. I don't think that stacks up either, because we know that the federal budget deficit, as I said earlier, broadly flat at around 6.5% of GDP. So I struggle to really justify the case, make a serious case that R star, the neutral interest rate, is a lot lower. The way that I could justify that argument would be that the combined effect of the Trump administration's policies, particularly as they relate to the labour market, is to slow potential GDP growth, therefore reduce the neutral interest rate. But of course, that's not the argument that Miran and others are trying to make. They're trying to make it from a position of economic strength. And I don't think that really stacks up.
You can take him to task for his attempt to justify, I mean, let's be honest here, justify Trump's demands that US interest rates be slashed. But isn't the key risk here that Miran at the moment is an outlier on the FOMC? But as we move into 2026, the committee, the shape of the committee is changing, and that his ideas are going to start moving center stage as the Powell era comes to the close, as the president gets more and more control over who sits on that committee.
Well, possibly, yes. But let's get some perspective here, right? So the other members of the FOMC that are potentially more aligned with the Trump view of the world, Christopher Waller, Michelle Bowman, there's no evidence in their dot plots that they're thinking that they believe that the neutral interest rate in the US is a lot lower along the lines of Miran or indeed Trump. And there's been much less willingness to kind of put an intellectual case together beyond just cyclical weakness for having to get interest rates down amongst some of those more kind of Trump-aligned, if you like, FOMC officials. So at the moment, it looks like Miran is an outlier. At the moment, it's difficult to justify anything in the data that would suggest that R star, the neutral interest rate in the US, is structurally a lot lower. And to the extent that anything changes to alter that view, it's going to be that potential GDP growth in the US is a lot lower because of the effects of the administration's policies. And clearly, that's not an argument that administration officials or those aligned to the administration are going to want to make. And frankly, if we look at the data, as you say, the data that have come in have been pretty strong so far. There seems to be, yes, a slowdown in the labour market, but potentially being offset by what may be the early stages of an AI boom feeding into investment and productivity growth in the US. Hence, GDP growth overall seems to be holding up relatively well so far. So an outlier at this stage, I would say, rather than something that's going to necessarily sweep over the whole FOMC. That's of course a risk, but I don't think it's one that should necessarily form our central scenario.
Okay, before you go, I just wanted to draw a contrast because we've spent a lot of time on this podcast, haven't we, over the years now, talking about upside inflation risks. And I was struck this past week by a report from our Europe team that talks about inflation there undershooting, the ECB possibly needing to cut rates next year by 50 basis points to address that. Why is there this contrast between what's happening in the EU and elsewhere in the DM universe?
It's really one of the, we spend a lot of time talking, don't we, about inflation in particular as it relates to the US, given tariffs and labour market and immigration controls and the potential of inflationary effects of both of those measures. But actually, inflation as it relates to Europe, it's the contrast and the Eurozone, the contrast is potentially more interesting with the UK, where UK inflation is increasingly looking like an outlier within the European continent, much higher than that of the Eurozone. Now, actually, when we look at the UK, I think it's the UK that's the outlier rather than Europe, actually. About 2/3 of the wedge that has opened up between UK inflation and Eurozone inflation over the past 12 months, we think can be explained by essentially one-off factors, administrative prices, tax changes, and so on and so forth. So that gap should close. The UK's inflation rate should fall closer to the European inflation rates. And that becomes a kind of new normal, if you like, for Europe. And that leaves the US with a slightly higher inflation rate, trend inflation rate, than say Europe. So maybe the Eurozone has an inflation rate just below 2%, UK about 2%, maybe a little bit higher, and the US 2.5% to perhaps closer to 3%. Now, why is that? Slightly more inflationary policies being pursued in the US, larger fiscal deficits, the effect of immigration curbs, tariffs having to work their way through the system. But by and large, if you take a step back and contrast the situation today with the situation, say, in 2022, where we had inflation rates of kind of 5%, 6%, 7%. And the debate then was, is this transitory? And of course, transitory became a dirty word because it took a long time for inflation to come down. I mean, I think, frankly, credit to Jay Powell, I think you would argue it's been transitory, wouldn't you? If you look at a long run inflation chart now, inflation went up very quickly. It came down a bit more slowly than it went up, but by and large, it's kind of back to 2 to 3% in most countries, which I think if you'd have said to most central bank officials, here's a potential outcome 3 or 4 years ago, they would have bitten your hands off.
That was Neil Shearing on tariffs, on the economic outlook, on rates, and what's going on with inflation. Don't forget that our tariff impact model and our trade hub more generally can walk you through the economic implications of country and product-specific US tariffs. This is available to subscribers of our Essential and Advanced all-access products, and they come with a host of options to download this data and plug it directly into your workflows. I'll add Marcel's report on Japanese manufacturers and that Eurozone inflation report that Neil was discussing at the end of the podcast notes too. On R-Star and Miran's thesis, we've got a drop-in. That's one of our short-form online briefings this coming Tuesday the 30th. The team will be talking about our estimates of the neutral rate in the US and elsewhere and the forces that are acting on them. I will add details to that session to the podcast notes. Look out also for drop-ins on our latest UK and Europe economic outlooks in the coming week. These are a chance to ask the team about their latest forecasts and analysis. On the UK, it's going to be very much about what the higher taxes that we are anticipating are going to mean for the growth picture. And as Neil and I discussed, the Europe team is going to be talking about how lower growth and inflation undershoots are going to bring the ECB off the sidelines in 2026. Also this coming week, our markets team is doing a special briefing that's going to be taking in their recent analysis on why demand for long bonds has been getting weaker, how US household exposure to equities has hit record levels, and the role of shifting trends within the pension industry that's driving those changes in asset allocation. That's on Tuesday at 9 o'clock London time, 4 o'clock Singapore. But as with all our drop-ins, if the time doesn't work for you, register anyway, get your questions in, and you'll get a recording with an answer as soon as it's concluded. Now, the US made a dramatic intervention this past week to calm Argentina's financial markets with support that includes a $20 billion swap line and pledges to buy Argentine bonds. This has been an extraordinarily fast and extraordinarily public show of support that's explicitly aimed at shoring up the Javier Milei government ahead of midterm elections next month. To find out what's driven the Trump administration to intervene like this and whether it's going to work, I spoke to Kimberley Sperrfechter, who covers LATAM economies on our EM team, and I started by asking her what has led Argentina to this point.
Yeah, I think this is quite unusual even by Argentine standards. Argentina is a serial defaulter, has been in financial trouble for most of its recent history. And we saw this change in policymaking when Milei came to power in late 2023. His stabilization program yielded big successes in terms of bringing down inflation, stabilizing the economy. And there'd been quite a lot of optimism towards Argentina as a result of that. But in the past few months or so, that's unwound and cracks have started to emerge. We had a corruption scandal involving President Milei's sister, who's one of his closest advisors. But I think when things really came to a head was after the Buenos Aires provincial elections back in early September, where Milei's party lost by a larger margin than people had expected. And I think that sent jitters through financial markets because those elections were closely watched because they're kind of seen as a bellwether for the crucial midterm elections in October. So yeah, that's when things really got worse. Argentine assets sold off sharply. The peso came under substantial downward pressure. It even breached the lower threshold of the trading ban, which forced the central bank to step in to prop up the peso. And that's kind of where I think US support comes in because Argentina's central bank last week alone spent $1 billion propping up the peso, which is quite a lot viewed in a context of Argentina's net FX reserves of just $5 to $6 billion. So there's a limited amount of ammunition that the Argentine central bank has to support the peso. So I think in that regard, the kind of financial support that Scott Bessent pledged for Argentina is crucial because they now have kind of the backing of the US, which I think then explains why we saw such a big positive market reaction after Bessent's comments.
Yeah, talk about that US support. I mean, the messaging from Bessent has very much been, we'll do whatever it takes to support Argentina. This isn't just charity on the part of the Trump administration, is it? I mean, what does the US get out of all of this?
Yeah, it's a good question. I think there's a couple of factors at play. So I think President Milei and President Trump, they are ideologically aligned, and I think it was noticeable that in a post on Truth Social, Trump said that the US had a tremendous relationship with Argentina, which has become a strong ally thanks to President Milei. And Scott Bessent called Argentina a, quote, systemically important US ally in Latin America. I think that's quite an important factor. So I think that's ideological alignment. And then I think it's also kind of plays into this kind of fracturing angle. What is interesting is Argentina's central bank has a 18 billion swap line with the People's Bank of China, although only 5 billion of that is active. And now Scott Bessent yesterday announced a $20 billion swap line that's under discussion with the US. So I think what's a factor that's also at play here is the US aiming to establish its presence in Latin America and kind of countering China, in particular in Argentina. And I think as well that if this crisis escalates, Argentina needs resources, kind of prevent Argentina from going to China and rather have it aligned with the US. So I think that's certainly a factor that's behind this financial support that was announced as well.
Is all of this support that the US has agreed or is putting together, is that going to be enough in the context of Argentina's economic problems? You're briefing clients, I know, earlier this week, and one client was asking about the currency specifically, saying, well, Milei on the campaign trail was talking about scrapping the peso, about moving to a dollar system. How far does US support go? How much of this is about an overvalued currency?
Yeah, so I think the crux of the problem of the current crisis actually is the overvalued currency. So basically what Milei had been doing, his kind of key aim ahead of the midterms in October was to keep the currency somewhat stable or more or less stable, to keep inflation on a downward trajectory. Because obviously inflation is a vote winner in Argentina, given the history of high and volatile inflation. So that was his main strategy: keep the currency stable, bring inflation down, and then hopefully we'll win the election. However, the overvalued exchange rate has created problems elsewhere. We saw the kind of comm deficit deteriorating, growth has been slowing and stuff. So it's kind of created this imbalance. And the issue is also that, as I mentioned earlier, Argentina, the exchange rate is overvalued. So that leaves it vulnerable to sharp falls of investor sentiment sours, which is exactly what happened after the Buenos Aires election. So we saw this sharp fall in the peso. Now, in terms of what US support will do, what we've already seen is it's the situation in Argentina's financial market has stabilized somewhat because it now implicitly has the backing of the US. So I think last week was an increasing risk that the government would have to abandon its crawling peg regime and let the peso fall. I think that risk has eased, and now it's looking more likely that Argentina's government might get through to the elections without a devaluation. However, I think what's really important to emphasize is that this just gives the government some breathing space ahead of the October election. It doesn't change the fact that the currency remains overvalued, which is something that the Milei administration will need to tackle if Argentina wants to record sustained growth and prevent further crisis going forward.
You keep mentioning this midterm election. Can it be framed as the sort of make or break for the Milei reform experiment? Is it going to be that critical?
I think it's definitely important. I think both from kind of a signaling point of view, because I think if Milei does well, that sends a clear signal to markets that Argentines are willing to stick with Milei's stabilization program, that they're willing to endure some of the costs that it entails for kind of the longer term benefit. But it also is important in terms of reforms that he will or will not be able to pass. Currently, Milei only holds a minority of seats in Congress, and he's hoping to increase his party's representation kind of in order to build a broader front, which would then enable him to carry out further reforms that Argentina needs, such as tax reform, labor reform, etc. So I think that's quite important as well. So if he manages to increase his representation in Congress, the representation of his party in Congress, he would still need a coalition partner, but I think it would give a boost to his reform agenda. If not, then I think further reforms are probably going to be quite difficult.
So it sounds like it's got implications for Argentine financial markets, for the stability there, for this economic reform program, but also actually going back to what you're saying about the US in the region, for US foreign policy as well. I mean, it's an election outcome that is going to have an influence there, isn't it?
Yeah, I think that's certainly the case. Obviously, big implications for Argentina itself. But I think it's also interesting to view Argentina's election in kind of the broader LATAM context, where we have a very busy electoral calendar. We have big countries, including Brazil, Chile, Colombia, Peru, all head to the polls in the next few months. And I think one theme that's emerging is that it's quite likely that in most of these countries, we're going to see a shift. That most of these countries are currently governed by left-leaning governments. And the latest polls suggest that there's probably going to be a shift from the left to the right. So I think that's probably going to be a key theme over the next year or so. And obviously also has implications from a fracturing point of view with regard to US policy towards Latin America and also China's influence in the region.
Kim Sperrfechter there on Argentina and US-China competition in LATAM against the backdrop of a fracturing global economy. Our fracturing work has much more on this competition. I'll link to our main fracturing hub in the podcast notes, along with a standalone analysis on China's growing role in Latin America. As Kim suggested, it helps explain much of what's driving Trump administration policy there. Our EM team will be closely tracking these regional elections, so watch out for their analysis, for more drop-ins, for more podcasts on that electoral calendar. We had William Jackson, our chief emerging markets economist, on the show last week, talking about how rising crime in Latin America could influence voting, so do check out that recording if you missed it. But that's it for this week. We will be back next week with a review of September US payrolls and much more from the world of global macro. Until then, goodbye.